Hey everyone, welcome to another episode of ADMAIL. This is Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everyone, welcome to another episode of ADMAIL. I'm Adam Bergman, tax attorney and founder of IRA Financial. And on today's ADMAIL, 3 really fun questions. 2 from social media, 1 from a client, and going to be tackling some really good issues on rollovers, and 2 on rollovers, and actually 1 on a non-deductible IRA. So let's just jump right in it. First question is from Twitter. Can I roll a Roth IRA into a solo 401k plan? I don't see any info on this on the IRS website. Well, actually, there's one graph that actually discusses this on the IRS website. And believe it or not, the Roth IRA is the only type of retirement account that cannot be rolled into a 401k. If your plan allows for it, you can roll over a Roth 401k portion into a new 401k, so long as the plan documents allow for it. But a Roth IRA is not allowed to be rolled into a 401k plan. A Roth IRA can only be rolled into a Roth IRA. That's it. Pretty simple rule. Not sure why they haven't changed it and allow for Roth IRAs to be rolled into Roth 401ks, although it doesn't really make sense. Why? Because with Roth IRAs, there's no required minimum distributions. That means once you're over the age of 72, you do not have to take any money out. In fact, you can pull the money out tax-free. Whereas in a 401k plan, Roth components have RMD requirements. So that means once you're over the age of 72, you actually have to take RMD distributions from the Roth 401k. The distributions would not be taxable, but you still have to pull the money out, which for most Roth lovers, that's not very attractive. So many people don't want to move funds from a Roth IRA to a Roth 401k. Why would you? Only reason I think is to take advantage of the ability to use leverage in a real estate deal, right? Under 514c9, you can use leverage, non-recourse leverage, to buy real estate, leverage up the asset, and not pay what's called unrelated business taxable income tax, or UBTI, as it's known. Whereas an IRA, the leverage use would trigger the UBTI tax. So that's probably the only reason to want to move funds from a Roth IRA into a 401k. Unfortunately, you can't do it. So thank you, Twitter, for that question. Second question is Harold P. from Rochester, New York. And Harold wants to know, how many rollovers am I allowed each year? Great question, Harold. The answer is, if it's direct, meaning going from custodian to custodian, IRA to IRA, 401k to IRA, IRA to 401k, direct rollovers or transfers, that's unlimited. 1,000,000 times, 100,000,000 times, 20 times a day, whatever you want. Direct is unlimited. So there's something called a transfer and a rollover. Transfers are IRA to IRA. That's, some people coin it a rollover, label a rollover. It's called a transfer. That's probably the right way to describe it. It's not wrong if you call it a rollover. It's the same thing. It's direct. 401k to IRAs, IRA to 401ks are rollovers. Both transfers and rollovers, so long as they go direct, meaning they're going directly between the retirement account, none of that money is passing through a person like you first, that's unlimited. If you do an indirect rollover, meaning the money goes to you first and then you send it to the new retirement account, that's called an indirect rollover, and that can only be done once every 12 months, and you only have 60 days to do it. Okay, so just be careful. Only can do it once every 12 months, not a year, once every 12 months, and you only have 60 days with that cash to do what you want with it. If you stay over the 60-day limit and go to 61, 62 days, it's fully taxable and subject to a 10% penalty if you're under the age of 59 and a half. So be super careful about that. There's been case law. One smart tax attorney tried to be aggressive and say it applies to each individual IRA. So he opened up a bunch of IRAs and tried to do indirect rollovers for each IRA. because he felt the language was vague on the IRS website. Bob Rowe case, he's not wrong. The language was vague. It was inconsistent. But the court basically said, no, it's once every 12 months for all your IRAs. So be careful. Use it wisely. It's a nice little, tool in your pocket if you need the money for 60 days. But just make sure you get that money there before. It's post-dated 60 days. But that's an indirect. So direct's unlimited, whether it's rollover or transfers. Remember, if you move money from a 401k to an IRA, you actually need a triggering event. So even if you want to move it out and roll it to an IRA, and even though it will be tax-free, if you're under 59 and a half or you still work there, you're not going to be able to roll that money out. So it's not going to matter. But IRAs to IRAs transfers, that's unlimited. If it's indirect, meaning the money goes to you and you want to use it for 60 days, once every 12 months, and make sure you get that money into another retirement account within 60 days. One other wrinkle, if you pull money, you got to put money back. So I've had the last 5 months, I probably the most requests for this information, I'd say in the last 10 years. Why? People took the money out and bought Bitcoin, and now it went up, and they're basically saying, oh no, I don't want to sell the Bitcoin and pay tax. Can I just put the Bitcoin back in an IRA? The answer is no. If you do an indirect rollover of cash, you got to put cash back. Same amount. Can't put less. If it's less, you're taxed a 10% penalty on the less if you're under, on that difference if you're under 59 and a half. So if you did take the advantage of the market swing and bought Bitcoin, and now it's 60 days later, you got to sell that Bitcoin, pay tax on it, and now pull the cash back into another retirement account, or the entire amount of the distribution will be subject to tax and a 10% penalty if you're under the age of 59 and a half. So just be wise, be careful, Harold. But thank you for the question. Third and last question today is from YouTube. And this person wants to know, why would anyone set up a non-deductible IRA? And it's a good question. There's really only two reasons to do it. It's because you have to. Non-deductible is basically you're caught in the middle. It's not a pre-tax IRA. There's no tax deduction. And it's not a Roth IRA where it's tax-free growth once you're over 59 and a half, and the Roth has been opened at least 5 years. So you're stuck in no man's land. You don't want to be there. Okay. Why do you have to be there? Well, two reasons. Number one, you want to make a traditional IRA contribution, but you make too much money. Okay. So 2021, you can put away $6,000 or $7,000, $7 if you're over 50. Believe it or not, it's not guaranteed that you can do it. Why? Because there's income limitations. So if you're single, and I'll go through the rules. If you are single, okay, and you are covered by a 401k plan at work, even if you don't participate in the plan, but you are eligible to participate, and you make more than $76,000, you cannot do a pre-tax IRA. The IRS is not giving you the ability to get a deduction. They don't want you doubling up the deductions. 19.5 or 26 if you're over 50 in a 401k, plus the 6 or 7 tax deductible in the IRA. They feel like that's too much deductions. If you're married, filing jointly, and your spouse is covered by a plan at work, $208,000. So if you make more than $208,000, you can't do the pre-tax, you got to do the after-tax. If you're married, filing jointly, and you're covered by a plan at work, if you make more than $125,000, can't do a pre-tax deduction. So those are the income limitations. So why do a traditional IRA then? Well, there's something called a backdoor Roth. So for Roth IRAs, which are after-tax IRAs, there's also income limitations. If you're married and file jointly and you make more than $208,000, you can't do a Roth IRA. If you're single, okay, or married, file separate, and you make more than $140,000, can't do a Roth IRA. If you're married, filing separately, and you live with your spouse, and you make more than $10,000, can't do a Roth IRA. So what do? It's called a backdoor Roth. You make an after-tax IRA contribution. Okay, so it's just a traditional IRA. You open a traditional IRA, IRA Financial or Schwab. You just don't take a tax deduction for it, right? Because you can't. You have too much income, or you have too much income and you have access to a 401k at work. And then you convert it to Roth. And since 2010, there's no income limitations on conversions. Before 2010, if you made too much money, you couldn't convert to Roth. But the economic crisis in 2009 basically allowed the IRS to open that rule up because they needed more tax revenue. So they encourage people to do conversions. Why? Because when you do a conversion, you pay tax on the amount you convert, which is really good to the IRS. Even though Roths in the long run will be disadvantageous, I should say, to the IRS because they'll be tax-free accounts. But as we know, government only cares about elections. They only care about the next 2 or 4 years. They don't really care about 30 years. They're going to be gone. So Roth conversions are good because it generates tax revenue today, even though Roths will be bad for the Treasury down the road. So if you want to do a Roth because you can't do a pre-tax IRA because you have access to a plan at work or you make too much money, or you want to do a Roth IRA but you make too much money, you do the backdoor Roth, which basically says you make an after-tax IRA contribution and then convert it to Roth. And since there's no conversion limitations, as long as you convert it quickly, there's no earnings on that amount in the account, in the after-tax IRA account, it converts. And since it's after tax, there's no tax because you're not getting the tax deduction. So there's no tax on the conversion, i.e. $6,000 after-tax IRA contribution. I make the contribution April 19th, April 21st, I convert it to Roth. The money was sitting in an account, no earnings on the $6,000, tax-free conversion. Now I have a Roth. And I was able to do that even though I make more than 208, even if I have access to a 401k at work. So that is the only reason you would do an after-tax IRA. It makes no sense to do it otherwise because you have pretty much the worst of the traditional IRA because you don't have the deduction, and you have the worst of the Roth IRA because there's no tax-free growth. So you're caught in the middle. It's no man's land. Don't want to be there. But you want to be there maybe for a day or so if you're going to do a Roth conversion because that's how you do the backdoor Roth IRA conversion. If you make more than 208 or you have access to a 401k and can't do a traditional IRA but still want to push more money into a retirement account, then the after-tax to Roth is the way to go. So thank you, YouTube, for that question. And there you go. That's another episode of ADMAIL. If you have questions, there are no dumb questions. It's probably the smartest thing I ever learned in law school. My first maybe day or so at law school, professor said, ask any questions. Don't be shy. There's no dumb questions. And she was right. There are no dumb questions. So ask them. Send them by YouTube, send them by Facebook, send them by Instagram, send them by Twitter. You can email them at info@IRA Financial. I get a lot of them. So if I don't get to your question immediately the next week, I will try to get to it in the coming months. I also do a bi-monthly, or actually a monthly, I would say now, Ask Adam, a YouTube live show, which will be coming up in the next few weeks. You'll get an email, or you can check it out on our YouTube channel if you subscribe, which I suggest you do, and you'll get a notification when I'm doing an Ask Adam, and then you can go on to YouTube and you can ask me a question and you could communicate with me and talk to me, and it's a lot of fun. I love doing them, and there's one coming up in the coming week. So check out our YouTube channel for more information. Subscribe if you haven't already, and you can ask me anything you want. Challenge me. I love being challenged. I'll tell you straight up if I don't know the answer. I'm not shy, and I'll tell you I'll research it and I will get back to you. The tax code is very, very in depth and it's very deep and it's very detailed. So there's no one in the world that knows every section of the tax code. I only focus really on two sections, 408, 408A and 4975. So really 2.5 to 3 sections, and 401. So I'd say 4 sections I specialize in. So and I don't know everything or every provision of each of those 4 sections because there's Treasury regulations, there's case law that really reference those sections and address them. So I'm always learning, and I love trying to answer all your questions because it forces me to stay sharp and forces me to keep researching, going back and learning more. That's why I love preparing for these podcasts, ADMAIL, which is probably one of my favorite, AdBits, which I look at a very specific subject in the self-directed retirement world. I just did one on Rule 55. I'm doing one also on the 72T election, which has been fun because it's forced me to go back and read through my notes and look at some of the, actually read some of the books I've written that has information on those rules. And just kind of see what's out there, check out treatises, check out tax code, treasury regs, see if there's any new rulings on those sections, which is a great exercise. And it's fun. It's fun trying to communicate and trying to figure out where clients are going and answer these questions. So thank you for sending them in. I really appreciate it. I'm trying to help you. You're actually helping me. So mutually we're benefiting, and that's so much fun. So thanks again. Stay safe. Subscribe if you haven't. And I promise I'll talk to everyone again next week. Be well.